Hi, my name is Pauline Bear, and today I'm going to be doing my presentation on Kava stock, which the ticker is CAVA. So Kava is a fast casual Mediterranean restaurant chain. The easiest way to think about it is it's like similar to Chipotle, but focus on Mediterranean food instead. The business model is built around customization, where customers build their own meals by choosing a base, protein, toppings, and sauces, and that's important because it keeps operations efficient and makes the model easy to replicate as they open new locations. And what really stands out about Kava is how well it fits into current customer trends. There's been a clear shift toward healthier eating, and Kava positions itself as a higher quality, health focused alternative to traditional fast food. And in terms of what drives revenue, their main product is customizable bowls along with pitas, salads, and sides like hummus. But the key point isn't just what they sell, it's the consistency of the model across the locations, which supports scalable growth. They operate in the fast casual segment, which sits between fast food and full service restaurants, so customers still get speed and convenience, but with better ingredients and a slightly better price point. So here are the key executives. This is the CEO, CFO, and the founder. Looking at the last 12 months, Kava's stock performance has been pretty strong with a 1-year return of approximately 90%. You can see the significant price swings on the chart. The stock actually peaked at a 52-week high of $99.70 back in May 2025 before pulling back later in the year, and the stock eventually hit a 52-week low of $43.59 in November, but it staged a major recovery since then to get a current price of $84.43 from when I made the presentation, when it was the presentation date. But while we were still off those May highs, the recent trend shows that the market is clearly pricing back in that growth trajectory after the slump we saw in late 2025. And if we look at the news from this past year, they explain those price swings just as we saw. Back in May, Kava was actually outperforming the rest of the industry and avoiding the general what was I saying? The general dinner pullback that was hitting other U.S. restaurants, and that suggested that their brand positioning was really holding up, but things got a bit rocky in June when the CEO sold about $2.4 million in stock, and then in August, the stock really took a hit. Management cut their outlook because of slowdown in sales, which made people worry if their growth was actually sustainable. But by November, the narrative started to shift. Analysis at Citi saw a big upside as economic shutdowns ended, which helped trigger that recovery we saw on that chart. And then we've seen analysis upgrades raising the target price to $95. There's definitely a lot more confidence in the company's future now that there was just 6 months ago. And looking at the ratios, Kava has a very strong liquidity position with a current ratio of 2.65. This gives them a lot of flexibility to fund their expansion, and their asset turnover is 0.93, which shows they are efficiently generating sales from their store assets, especially with that 22.41% year-over-year revenue growth. And by the way, all of this data is from March, from the date I was supposed to present. And on the profitability side, they are posting a net margin of 5.40% and an ROE of 8.64%. They're not at mature levels yet, but being profitable this early while still expanding is a big advantage compared to companies like Sweetgreen. And the PE is 137.95, which is which is a high growth multiple, and it shows that the valuation is based on future earnings expectations as they hit economies of scale. Finally, with a debt to equity of 0.60, they have a relatively conservative leverage profile, which leaves them room to tap into debt markets if they need to later on. And moving into capital structure, Kava is almost entirely equity funded with 93.7% equity and just 6.3% debt. This is very low leverage, and that's typical for a high growth company prioritizing flexibility over the tax shields you'll get from higher debt. And looking at the cost of capital, we have a cost of equity of 15.1% and a cost of debt of 4.7%, leading to a WACC of 14.4%. And the high cost of equity is driven by a beta of 1.46, which reflects the stock's higher validity, reflective to the broader market. And looking at the relative valuation, Kava is clearly trading at a premium. Its PE is about 138 compared to around 26 for Chipotle and 71 for Shake Shack. And we see the same thing with EV to EBIT. Kava is around 49, which is much higher than Chipotle, though still below Sweetgreen. And Chipotle has the highest margin at about 12.9%, while Kava is 5.4%. So it's not at that level yet, but it's already ahead of Shake Shack, and it's at a much better position than Sweetgreen, which is still losing money. So the market is basically pricing Kava based on where it could go, not where it is right now. Investors are expecting that the company scales, margins will improve, and move more closer to companies like Chipotle. The current price for Kava is $84.43. My 12-month target price is $96, which implies around a 12% upside, and that estimate is based on continued revenue growth and some improvement in margins as the company scales and becomes more efficient. As they open more locations, costs start to level out, which can help improve profitability over time. And at the same time, the stock is already trading at a premium, so a lot of that expected growth is already priced in. So even though there is some upside, it's still below the required return of around 15%, and that's why the return doesn't fully justify the level of risk at current prices. And so my final recommendation is to buy, but maintaining for the long term. The main reason is that Kava is still so early in its national rollout. The company is still growing, and for 2026, they're actually just about to open 74. They're about to open 76 locations instead of 74. Which is big for them, and they're also starting to test higher end menu items to get people to spend more per visit, like pomegranate glazed salmon they're launching this month. And looking at the risks, the stock is expensive. It's trading at a massive premium, and their margins obviously aren't at Chipotle's level yet. There's also some execution risk as they move into new markets like the Midwest, where people might not know the brand as well. But even if we hit a recession, I think Kava will still do okay for the restaurant market. Of course, hitting a recession in the restaurant market will be the worst out of all of them, one of them. And but as Kava being one of the restaurants out of all of them, I think they'll be okay. They just dropped a new loyalty program to keep their top customers coming back, and honestly, for a lot of people, a $16 healthy bowl is kind of a non-negotiable. It's that small luxury that people keep in their budget even when they stop going to expensive sit-down dinners. With a clean balance sheet and this room to grow, I think the upside is definitely there. So yeah, thank you so much. I really, really apologize for this presentation being late. Thank you so much for having me in your class.